Ever wondered where to park your money in 2023? It's a question that's on many minds these days. In an era where the financial landscape is constantly shifting, making smart investment decisions is more critical than ever. This year, 2023, is no exception. In fact, it's unique in its own right. This year, we're seeing unprecedented fluctuations in market trends, creating both opportunities and challenges for investors. The pandemic's residual impact, the rise of digital currencies, and the increasing influence of environmental, social, and governance factors are all reshaping the investment landscape. But fear not, because in this uncharted territory, there are still solid places to park your money, places that can offer you a good return on your investment and a sense of financial security. This is where we come in, to guide you on this journey of financial exploration. So, without further ado, let's dive right into the top 5 places to park your money in 2023. Starting our countdown at number 5, we have real estate. Now, real estate has long been considered a haven for investors seeking stability and potential appreciation, but what makes it such a reliable asset class? Well, let's delve into that. Real estate, unlike many other investment options, is a tangible asset. This means you're not just investing in numbers on a screen, you're investing in physical property, something you can see, touch, and use. This tangibility provides a sense of security that can be incredibly appealing, especially in uncertain economic times. Another key advantage of real estate is its intrinsic value. Regardless of market fluctuations, a property will always retain some level of value. After all, we all need a place to live, right? This makes real estate a relatively low-risk investment, particularly when compared to more volatile markets like stocks or cryptocurrencies. Now, let's talk about potential for appreciation. Over time, property values tend to increase, often outpacing inflation. This appreciation can result in significant returns on investment, especially for long-term investors. However, it's important to remember that while appreciation is likely, it's not guaranteed. Market conditions, location, and other factors can all impact property values. But real estate isn't just about buying and holding, it's also about generating income. Rental income, to be exact. Owning rental property can provide a steady stream of income, often covering the costs of ownership and even providing a profit. This income can be particularly beneficial during retirement, acting as a sort of pension. Of course, like any investment, real estate comes with its own set of challenges and risks. Maintenance costs, property taxes, and market downturns can all impact profitability. It's crucial to do your homework and understand the market before diving in. So, real estate, a tangible asset that can provide both income and potential appreciation, takes our 5th spot. It's a solid choice for those seeking a stable, long-term investment with the potential for both capital growth and income generation. Coming in at number 4 on our list, we have bonds. Now, if you're looking for an investment that's a little more on the stable side, bonds might be just what you're after. But before we delve deep into the world of bonds, let's start with the basics. What exactly are bonds? Well, to put it simply, when you buy a bond, you're essentially lending money to the issuer. This could be a government, municipality, or a corporation. In return, the issuer promises to pay you back the full amount at a specified maturity date, along with periodic interest payments. Now, why would anyone want to invest in bonds? Well, there are a couple of reasons. The first one is stability. Unlike stocks, the value of bonds doesn't tend to fluctuate wildly. This makes them a popular choice among investors who prefer a slow and steady return on their investment. The second reason is the balance of risk and reward that bonds offer. With bonds, you're essentially trading the potential for high returns for a lower level of risk. It's like the old saying goes, the higher the risk, the higher the potential return. But with bonds, while the returns might be lower, the risk is also significantly reduced. Bonds also act as a hedge against stock market volatility. In other words, when the stock market is doing poorly, bonds often do well, and vice versa. This inverse relationship can act as a safety net for your investment portfolio, helping to smooth out the ups and downs of the stock market. Finally, bonds offer a predictable income stream. The interest payments you receive from bonds can provide a steady source of income, which can be particularly appealing for retirees or those nearing retirement. So there you have it. Bonds may not be the most thrilling investment out there, but they offer a solid balance of risk and reward, stability, and a predictable income stream. For these reasons and more, bonds, for their balance of risk and reward, secure the 4th spot on our list. Halfway through our countdown, at number 3, we have the stock market. The stock market is a vibrant, bustling hub of economic activity that can offer potential high returns. It's like a roller coaster ride, exhilarating, unpredictable, and if you're not careful, it can make you feel a bit queasy. But fear not, with the right strategy and a cool head, it can be a thrilling journey to financial growth. Investing in stocks is akin to becoming a part owner of a company. When the company performs well, you reap the benefits. However, it's not always a smooth sail. The stock market is volatile, and prices can fluctuate wildly in a short span of time. But remember, with higher risk comes the potential for higher returns. Now you might be wondering, how do I navigate this labyrinth of numbers and trends? The answer is research, my friend. Staying informed about market trends is crucial. It's like having a roadmap in an unfamiliar city. You need to know the terrain before you start your journey. Researching companies, understanding their business model, studying their financial reports, and keeping an eye on indicators can give you a significant edge. It's like being a detective, piecing together clues to make an informed decision. But don't let the complexity deter you. There are plenty of resources out there to help you, from financial news outlets to investment apps that simplify the process with user-friendly interfaces and in-depth analysis tools. Moreover, it's not a one-size-fits-all deal. There are various strategies you can adopt depending on your financial goals and risk tolerance. From blue-chip stocks known for their reliability to growth stocks with high potential, the choice is yours. An important point to remember is that investing in the stock market is not a get-rich-quick scheme. It requires patience and a long-term perspective. The market might experience downturns, but history has shown us that it has the capacity to recover and reach new heights. With the potential for high returns, the stock market takes the third spot on our list. Coming in at the runner-up spot at number 2, we have peer-to-peer lending. Now, what exactly is peer-to-peer lending? Let's break it down. It's a method of debt financing that allows individuals to borrow and lend money without the need for a traditional financial institution. That's right, it's lending without the middleman. With the digital revolution, this form of investing has become more accessible than ever before. Technology has made it possible for everyday investors, just like you, to become a part of this exciting venture. You can lend your money directly to those in need and in return, receive interest on your investment. So what makes peer-to-peer lending so attractive? One of the key draws is the potential for above-average returns. Compared to traditional banking options, the interest rates in peer-to-peer lending can be significantly higher. This is because you're taking on a greater risk by lending directly to individuals or businesses. But remember, with great risk can come great reward. However, it's important to note that, like all investments, there are risks involved. Always do your research and understand the platform you're investing through. In essence, peer-to-peer lending is a modern twist on an old concept of lending and borrowing. It allows you to take control, diversify your investments, and potentially earn substantial returns. With its modern twist on lending and potential for great returns, peer-to-peer lending secures our second spot. And now, the moment you've all been waiting for. The number one place to park your money in 2023 is a diversified portfolio. Let's unravel the concept of diversification. Picture a financial buffet where you're not just picking one dish, but a little bit of everything. That's diversification in a nutshell, spreading your investments across a broad spectrum of asset classes. This can include stocks, bonds, real estate, and even peer-to-peer lending, as we've previously discussed. Why diversify, you ask? It's a strategy that allows you to spread risk. By not putting all your eggs in one basket, you cushion yourself from potential financial blows. If one sector goes down, the others can help balance out the losses. Think of it like a financial seesaw, where the ups and downs are kept in equilibrium. But don't be fooled. Diversification is not just about playing defense. It also offers the potential for substantial rewards. As different sectors grow at different rates, a diversified portfolio can help capture gains from high-performing assets while being shielded from the full impact of underperformers. In essence, a diversified portfolio is like a well-rounded athlete. It's not about excelling in just one area, but having a balance of strengths that can navigate through various challenges. So there you have it, the best place to park your money in 2023 is in a diversified portfolio, offering a balance of risk and reward for the savvy investor.